So you're about to retire, you've saved up money in your IRAs and 401ks, and you're wondering when you retire, should you start taking Social Security, or should you focus on Roth conversions, or should you do both? And I find a lot of times people don't recognize, I'll call it the tax surprise that comes with taking their Social Security. So today we're going to walk through a hypothetical example of Bob and Peggy Sample, and I'll show you their situation here in a second, showing what would happen if they were just to do Roth conversions up front, or what if they were to just start taking their Social Security, and how does that impact the Roth conversions that they could do, and also how do Roth conversions impact what they're doing from a Social Security standpoint. So let's just take a look at their overall situation here. We've got Bob and Peggy Sample. Now, as you can see here, they've got about $100,000 in a high yield savings account, $400,000 in a brokerage account, and then they've got about $1.5 million in their IRAs. So they've got a couple things going on here as we take a look at their total financial health statement. The $1.5 million in their IRAs, as they know and are thinking, that's why the question comes up about the Roth conversions. They know come in their 70s, they're going to have to start taking required minimum distributions, forced income from this account, which will add to their taxable income in the future, potentially putting them in higher tax rates in the future than where they're at today. Another opportunity that I see as looking at this total financial health statement is the money that they have in their high yield savings account as well as in their brokerage account. Now that's money that could potentially allow them to delay their Social Security, live off of those savings accounts and those brokerage accounts, and potentially do some Roth conversions at a lower rate. So which one makes more sense? Well, a lot of times it depends on your priorities. What are you prioritizing for your life and for your retirement? You know, for some people, their priorities might be to lower the lifetime taxes that they're going to pay to the IRS. And so with that case, maybe Roth conversions then are their priority, and maybe not. Well, we're going to talk and show different examples and scenarios of how it impacts them from a tax standpoint. Or maybe your priority is to start taking Social Security first. And if you are, I kind of, we use this analogy and make you kind of really think about that. Are you taking Social Security right away because you're trying to solve a pain that you have? Like, think about this. If you had a headache, everybody, does something different. I'll take Advil. My wife drinks a lot of water, and some other people might do something totally different than that. So are you just using Social Security to solve a pain because it might feel uncomfortable to go to your brokerage account and start withdrawing money that you've saved up? And so that's where a lot of times, we're helping clients with their retirement planning, helping them understand that, wait, it's okay to take from the brokerage account first and keep your taxable income low. And I'm going to show you that in the projections versus starting your Social Security right away. However, I also understand that a lot of people believe, hey, I've paid into Social Security for a lifetime, and I want to get the most back from that as well. So again, it comes down to your priorities, and I'm going to show you how each one kind of comes into play here when it comes to Bob and Peggy Sample. So the other thing, if you caught they're age 65, and we're just going to imagine they're retiring at the beginning of the year of being age 65, and take a look through a few different scenarios here. So let's dive into the examples and scenarios. So let's just say we've got, again, Bob and Peggy Sample. And what we're using this system here to do is say, what would they pay in taxes based on if they were to do a Roth conversion versus if they were to do Social Security and a Roth conversion. If they start taking Social Security and they do the same Roth conversion, what does that mean? What's that retirement tax surprise that I was talking about that comes with Social Security? And how does it impact everything depending on their priorities? So let's just start on the far left-hand side of our again, hypothetical example here. But let's start on the far left-hand side. And what this system here is doing is it's just going to project out the taxes owed based on their situation. So on the far left-hand side, we're just kind of showing you where they would potentially forecast to be by the end of the year based on their current situation, but without doing any sort of Roth conversions and without doing Social Security. So for all of us, then that's going to set the baseline where they're at today, and then we'll see how that's impacted based on doing Roth conversions or based on taking Social Security and adding Roth conversions to that. So just walking down here, as I mentioned, they are retired, so we've got no wage income coming in. Now, we did have some money there in the high interest savings account, so that's going to create some, or high yield savings account plus in their brokerage account. So it's going to create some taxable interest through the year for them, forecasting about $5,000. They've got dividends coming in off of their brokerage account, about $6,500, $4,000 of those being qualified dividends. So know this, qualified dividends can get taxed at a more favorable rate, long-term capital gains rate. I'm going to show you where that comes in as we go through this as well. But again, baseline, so not adding anything like Roth conversions or Social Security yet, so we can kind of see what's the better decision to make. This is what we go through with all of our clients. So nothing coming in, no Roth conversions, no Social Security. Because they have that brokerage account, they do have some gains. Again, projecting maybe about $1,000 in short-term gains, $8,000 in long-term capital gains. So $9,000 total in gains, but this one right here is very interesting as well. So $8,000 in long-term capital gains also can get taxed at the long-term capital gains rate, more favorable than ordinary income tax rates. Now we'll continue down. Let's just say for our sample here today, right? No extras added in, but what we're able to do if people had Schedule C or Schedule E or Schedule F income, or we're taking a look at that as well, adding anything into their situation as we do the comparisons. So total income coming in before they do Roth conversions or taxes or anything, $20,500. And then guess what? Bob and Peggy here, they get the $32,000 standard deduction. And so if we look at that, what does that mean for them right now before they add anything in? They'd actually have zero tax. You might be like, wait, what? Well, yeah, because they just have $20,500 of income coming in, but because of that standard deduction, they won't owe any tax to the IRS. So we're using this as our baseline then to help you understand, well, should we proceed down that path of Roth conversions, or should we take Social Security and do Roth conversions? And which means more? And again, it's a lot of it's going to come back to your priorities. Are you trying to, is your focus reducing the long-term taxes that you're going to pay to the IRS? Or is it just to get most out of, or just to start taking from Social Security because you've paid into it for a lifetime? So let's go back, and I'm going to explain to you how we're going to start to do this analysis here. As we go back, so one of the first things that we're going to take a look at, so we just talked about the baseline. And in the baseline, you saw that there was income coming in. We had $9,000 of gains. There was dividends. There was interest. All of that baseline sits right here called our zero line. When we take a look at this chart here, that's the zero line. Yes, I understand that there was more that was coming in, but we're saying that that's zero. And then what we're going to do in this chart is as we go to the right, what that means is that that's additional taxable income that they would take on, and it's going to show us what tax rates that would put them at. So the first thing that we're going to look at here is what if they were to focus on doing Roth conversions? Not taking Social Security. What if they're to focus on doing Roth conversions? So for instance, as I just move over a couple $4,000 to the right here, this is saying to their baseline, if they had $4,000 of Roth conversions, as you can see here, they'd still be in the zero, they'd still be paying 0% in tax, meaning $0 that they would owe in taxable income. And you can see actually it jumps up there at about, what's that, 25,000. What does this mean? It means that they could do $23,000 of Roth conversions, and actually they wouldn't potentially owe any tax. And again, with all of this, I mean, you want to talk to a qualified financial professional as well as your tax professional. We're just doing projections today just to kind of give you that idea. But that's powerful right there. Think about that. They could take $23,000 from their IRA, move it into their Roth IRA, and actually wouldn't owe any tax. They're getting it out of their IRA and over to the Roth, where it's going to grow tax-free, and all of the gains will come out to them tax-free as well. I mean, seems like a no-brainer right there. Let's keep continuing down here. So we go down, and now we're in you can see the top there. It says 10% federal tax bracket. So looks like we can do that first $23,000 at no tax, and then we go all the way up to $48,000. So the next, what's that, $25,000 now is going to get taxed at, or $24,000, right? Somewhere in there, it's going to get taxed at 10%. And they might say, well, that seems pretty, good idea too. Again, taking this money that we could be in higher tax brackets or higher tax rates in the future, maybe we want to pay 10% on it today. And then continue on. And this is where a lot of the trade-offs come. And we're going to, we continue to go through this with clients to say, okay, here's how much we can do. Here's the different impacts. Do you feel like this makes sense based on the tax projections? If you've seen some of our videos before, the other thing that we do is the tax projections, showing here's where we project out your taxable income to be throughout your future and which tax brackets you would sit in. So we continue to go down to the right here. And I'm going to show you a few interesting things. So right here, right, 105,000 is before this red section jumps in. And what's that red section? Well, as we go right into that red section there, look at that. Oh, very interesting. 15% capital gain. So that's actually when the capital gains tax would start coming in for them. So what am I trying to say here? Well, remember when I said that qualified dividends, and I was also talking about the long-term capital gains that they had of $8,000. Everything to the left, if they stuck to an income level to the left of this line, it's meaning that they would actually get those long-term capital gains and those qualified dividends at $0 in tax, because those are taxed at a more favorable rate that start at 0%. So that's where something comes into play too, to say, okay, well, hey, if we stick to that $105,000, we're going to get some of our other money, some of these qualified dividends, some of these long-term gains, we're actually going to get those for free as well. So, or when I say for free, not have to pay any tax to the IRS. So that's where, again, things come in. Now, maybe they've looked at their situation, and in their future, they know that they're going to be way up in the 22% bracket or the 24% bracket, or when those expire, it could be 25 and 28% bracket. So maybe they then decide, hey, we'll go up into the 22% bracket to do our Roth conversions. And you'll see some of these dashed lines as we go along here. And what this dash line is to say is that, okay, well, if they did $185,000 Roth conversion and they stuck to the left side of this dash line, they're not going to have to worry about, they shouldn't have to worry then about Medicare IRMA, but they go over the dash line, over that amount of income. Next thing you know, Medicare IRMA is going to start to kick in and take into play here. So a lot of description to help you understand. There's a lot to look into when you're considering a Roth conversion, because it adds, when you do a Roth conversion, it adds taxable income to your situation. Depending on how much taxable income you add to your situation, now other things start to come into play. So just to keep things simple for today, we're going to say, what if Bob and Peggy wanted to stay to the left of the red section here, meaning where they wouldn't then owe taxes on those long-term capital gains and those qualified dividends. So we're going to say, hey, they're doing $105,000 of a Roth conversion. So we go down here, and in our middle column now we're in our middle column. This is the column to say, what if they decided basically that they're going to live off the savings account, live off the brokerage account, and just do Roth conversions. So in here, we're going to go ahead and we're going to add in, let's say they do $105,000 of Roth conversions. Again, that keeps them to the left of that line in that bracket there. And if we go down, so that way we can compare from a tax standpoint, everything else stayed the same in their situation. Total income now $125,000. but they get that $32,000 standard deduction, takes them to a taxable income of $93,200. And as we talked about, they're going to be in that 12% tax bracket. And the total tax that they would owe on that situation is $9,280. So effectively, the effective rate is what you'd kind of consider average rate of tax that you're paying. The average rate of tax that they're paying then on that Roth conversion is 10%, meaning the average rate of tax that they're paying on that money that they're shifting over into their Roth bucket is 10% on average. So that's, again, with just a sole focus on Roth conversions and saying, hey, we're going to delay our Social Security till later. Now, what if they instead say, hey, we've paid into Social Security for a lifetime and we want to get everything that we can back out of it, and we just feel, super uncomfortable, and we want to start taking Social Security right away because we want that type of income coming in. Is that the right decision? Again, everybody's plan is unique and different. That's where you want to put together a plan, and I'm going to show you here how it can also, impact things from a tax standpoint. So let's go back. And we're going to take a look here at things from that standpoint to say, what if they were to start taking Social Security? So that's our third column here with Social Security included. And we scroll down. We got all the same other situation. And then we take a look here. They've got 60. If they started their Social Security right at retirement, they'd have $64,800 of Social Security coming in. And you might say, well, great, I've got Social Security coming in, shouldn't have to pay any tax, right? Well, actually, that's the retirement tax surprise when it comes to Social Security, is depending on how much income you have coming in, up to 0%, or up to 50%, or up to 85% of your Social Security can then add into your taxable income. So gross Social Security, $64,800, taxable Social Security, $13,500. So we can scroll down here and see, let's see here, we get down to the total tax though, because guess what? Total income's $34,000 minus their standard deductions, taxable income. Basically, they're still going to be at about $0 in total tax. So what now can they do when it comes to their Roth conversions? Let's look at the same thing. But you'll notice this map now looks a little bit different. So because the baseline, remember their baseline includes Social Security. Previously, the baseline didn't include Social Security. So just show you a little bit of difference here, right? Here is the one without. Here is the one with. And you'll see this big purple section comes into play here. What's that purple section? Well, it means depending on how much additional income they add to where they're at today, the Social Security taxation phases in. So again, what's the priority? If the priority was to reduce the taxes, well, they've really just changed the game and situation on how much they can convert over to their Roth IRA. You can see here they'd stay at that 0%, basically in 0% tax rates, but that jumps up now at $6,000. So they can do $5,000 of Roth conversions and have no impacts. Remember, before we were in like $20,000 of Roth conversions where they wouldn't have to pay any tax. But that's where the impact starts kicking in. And you can see here the Social Security tax starts kicking in as well. And as they continue to go over, that continues to kick in. Now, let's just say they said, okay, you know what? We understand that. We understand we've got to pay some tax on our Social Security, but can we still get those capital gains for free? And same thing, right? If they wanted to go into this bracket here, now it's just a different amount before they start crossing over the Medicare line. But let's just say, just because I want to show you kind of the impacts of everything, they're like, okay, same thing as last time. We want to get our long-term capital gains for free, and we want to get those qualified dividends without paying any tax on those as well. So how much additional income can we take in? Meaning, how much can we convert to Roth before that would happen? It shows here $50,000. So if we go back to our situation here and we say, okay, And I want you to remember this number right here, taxable Social Security, $13,500. Now, if they then also wanted to do those Roth conversions to get them up to that spot where they would potentially not owe any tax on their long-term gains, look at that. We do $50,000. Now look at that taxable Social Security, and that makes such a huge difference here. And now, just by doing a $50,000 Roth conversion, $55,000. It used to be around $13,000 before. Now $55,000 of their Social Security is adding into their taxable income. And so if we scroll down to the bottom, kind of look at everything here, total income, pretty much the same, right? Adjusted gross income, standard deduction, that's the same. Taxable income, the same. So same, pretty much total tax, $9,280 versus $9,290. But again, it's what is your priority? Because in our middle column here, where they were focused on, reducing their long-term taxes, it appears that it makes more sense then to focus on the Roth conversions. They're able to get twice as much converted from their IRA over to their Roth IRA, growing tax-free for their future, versus the other column where they took Social Security. And because they took Social Security, now all of a sudden that's changing the game because some of that Social Security becomes taxable. So the folks, if they were to take Social Security, they're only able to convert $50,000 from their IRA over to their Roth IRA. So in my opinions here, if Bob and Peggy came in and said, our focus is reducing our long-term taxes, but we're really nervous and we think we should start taking Social Security because we no longer have our employment income coming in. My opinion is I'd say, hey, we need to put together a plan that shows you that you can live off of your savings in your brokerage account, and I'd really focus on doing those Roth conversions because you'll be able to convert more over to your Roth IRA, helping to reduce potentially your long-term taxes. Now, if Bob and Peggy came in and they said they have a lot of health issues and maybe longevity was a concern to them, then maybe they would want to start taking their Social Security, because then that way they're collecting the most from Social Security that they can. Everybody's situation is unique and is different, and the important part is putting together the projections, understanding the different impacts based on the income that you have coming in. So if that's something that you're looking for help on, or you're just wondering if it's okay to retire, when you can retire, how you can delay your Social Security and do Roth conversions like this, those are all areas that we help people out with each and every day, people just like you. So if you need help with those as well, you can go to lifemoneyshow.com and click on the Work With Us tab. Hey, if you've enjoyed today's video, you want to see additional topics on retirement, how to reduce the taxes on your IRAs and 401ks, and how to help maximize your Social Security, subscribe to our YouTube channel. That way you'll get notified as we're coming out with new videos each and every week on topics just like those. Thanks, and have a great day.